Hello and welcome back to The Note. The emerging market sell-off continues, and that raises many fascinating questions, not just about the emerging markets, but about those who are selling off. The big institutions that generally have far more invested in emerging markets than they did a decade ago. Are they ready to stay the course, or is there any risk that they will panic? What is driving those institutional investors? With me now to discuss this is an expert on the field. He's the Chief Executive of Create Research here in the UK, Amin Rajan. Amin, thank you very much for joining me once more.
Thank you.
Let's start by taking a look. You do these regular, enormous surveys of the fund manager community, and one of the critical questions is whether emerging markets are a buy and hold story or an opportunistic story, something for trading in and out of.
Yeah.
Take me through what you discovered in this chart here on institutions' choices for opportunistic investments.
Yeah, I guess to put it into context, the best thing is to really go back to 2002.
Yeah.
We have been carrying out these surveys for the best part of the last 12 years or so. And in each of those years, after 2002, emerging market story was gaining traction as a buy and hold story, not an opportunistic story. So what we found was that until about 2012, more and more allocations were made on the basis that emerging markets will come good, and it's really worth hanging on to emerging market stocks and so on.
Okay, so this is like the big brick hypothesis and so
yeah.
on. There was a lot of hype that this was the way to grow for the long term.
That's right, and there was evidence behind many of the countries doing really well and so on. However, since 2012, the degree of opportunism in emerging market has increased, and the overall emerging market story as a buy and hold story is weakening somewhat. So when we did our last survey, we ranked various asset classes in terms of whether they really are part of the opportunistic bucket or buy and hold bucket. And we find here that emerging market investment grade bonds and emerging market equities, they used to be right at the top there. In other words, they really were a very small part of the opportunistic bucket. And their share of the opportunistic bucket has been rising. And I guess that as a result of the current crisis, that's likely to rise even more. Basically, what that means is that people are going to look for quick kills and get out.
Okay, it's a hair trigger investment at this point, which indicates higher volatility, more of a problem for emerging markets trying to run their economies.
That's right.
Now let's take a look at the results of when you asked the same question about buy and hold investing.
Yeah. Now here, if we go back to, say, 2008, emerging market equities and emerging market government bonds, these two lines, they were really right at the top there. As was global equities with emerging market revenues, as was emerging market investment grade bonds. They were really right at the top. The implication was that, after the worst of the crisis here in the West, people were sort of saying, let's look to the East. There are some really good opportunities there. And so more and more allocations were made. If I can give you some numbers, back in 2002, the average allocation to emerging markets on the part of DB plans in the West would be somewhere in the region of 2 to 4%.
Right.
Now it stands somewhere between 10 to 12%.
So we've roughly tripled.
It's roughly triple.
Right.
You're talking about a shift in assets of the order of something like $2 to $3 trillion.
Wow. Now, is the way in which they invest, which as I understand it is more predominantly, even institutions tend to hold EM assets passively, and often they tend to use ETFs, which obviously you can trade at any minute. Does that create any further distortions, any further tendencies towards buying and then selling rapidly? Yeah.
Now, some institutions really follow their retail peers, and they've used the ETF as the main route to getting into emerging markets. So again, when one looks at the emerging market ETFs, they have really rocketed in the last 3-5 years or so. Equally, there are other institutions who make direct investments. So, for example, if you look at the Scandinavian pension plans or the Dutch pension plans, they're making direct investments themselves. They're not using any intermediaries, nor are they using vehicles like ETFs or index funds. So it's really a combination of both. I would say it's more of the latter rather than the former for institutional investors, and ETFs largely for retail investors.
And final question, I mean, do you think ETFs contribute to contagion? Many of them will cover many markets in one go, so does that mean that if you decide you want to sell one country, you automatically sell a bunch of others at the same time?
Well, it's hard to say that it is the cause of contagion, but it is definitely accelerating the contagion. There is absolutely no doubt about it, the way the ETFs are constructed. And there is a fear that ETFs can make matters far worse than they need to be.
Okay, I mean, thank you very much.
Thank you.
It's always a pleasure. I think the one takeout from that, whatever you think about emerging markets, the underlying fundamentals, plainly the risk is there that we're going to see that much more of a sell-off given the way the state of the institutions investing in them. If you want some positive take on that, that's bound at some point to create value for those who are prepared to look for it.